morning. I'm very pleased to be here with the Senior Deputy Governor, Carolyn Rogers, to discuss our policy decision. Today, we lowered the policy interest rate by 50 basis points. This is our 5th consecutive decrease since June and brings our policy rate to 3.25%. Monetary policy has worked to bring inflation back to the 2% target. Our policy focus is now keeping inflation close to target.
Today, we lowered the policy interest rate by 50 basis points. This is our 5th consecutive decrease since June and brings our policy rate to 3.25%. Monetary policy has worked to bring inflation back to the 2% target. Our policy focus now is to keep inflation close to that target.
We're seeing in the economy and how that played into our decision. In the United States, the economy continues to show broad-based strength, and inflation has been holding steady. The U.S. dollar has appreciated against most currencies, including the Canadian dollar. Canada's economy grew by 1% in the third quarter, which was slower than we expected. Recent data also suggests growth will be lower than projected in the final quarter of this year. Growth in the third quarter was pulled down by business investment, inventories, and exports. But consumer spending and housing activity both picked up as lower interest rates started to boost household spending. Canada's job market is still softening. Businesses have continued hiring, but the number of people looking for work has been increasing faster than the number of jobs. The unemployment rate rose to 6.8% in November. It has been especially hard for young people and newcomers to Canada to find work. A number of policy measures have been announced that will affect the outlook for growth and inflation in the months ahead. The most significant of these is reduced immigration targets, which suggest GDP growth next year will be lower than we forecast in October. The effects of lower population growth on inflation will likely be more muted because reduced immigration dampens both demand and supply in the economy. We'll have more to say on this when we release our next forecast in January. Other federal and provincial government policies, including a temporary GST break on some consumer products, one-time payments to individuals, and changes to mortgage rules, will likely affect the dynamics of household spending and inflation in the months ahead. Again, we'll have more to say on this in January. As always, we will look through the effects that are temporary and focus on underlying trends to guide our policy decisions. CPI inflation has been about 2% since the summer, and we expect it to be close to target on average over the next couple of years. We thought elevated shelter price inflation would continue to ease, and it has. And the downward pressure on inflation from goods prices has also moderated as predicted. We expect the GST holiday to temporarily lower inflation to around 1.5% in January, but that effect will unwind after the GST break ends in mid-February. We will be looking at measures of core inflation to help us assess the trend in CPI inflation. While the upward and downward pressures on prices have been moderating, risks to the inflation outlook remain. Elevated wage increases combined with weak productivity could push inflation up. Or the economy could keep growing below its potential, which would pull inflation down. In addition, the economic outlook is clouded by the possibility of new tariffs on Canadian exports to the United States. No one knows how this will play out in the months ahead, whether tariffs will be imposed, what exemptions get agreed, or whether retaliatory measures will be taken. This is a major new uncertainty. En résumé, l'inflation est de retour.
To summarize, inflation is back to the 2% target, and lower interest rates are beginning to pass through to stronger spending by households. But the economy remains in excess supply, and the growth outlook now appears softer than we projected in October. With inflation back to target We have cut the policy rate by 50 basis points at each of the last two decisions because monetary policy no longer needs to be clearly in restrictive territory. We want to see growth pick up to absorb the unused capacity in the economy in order to keep inflation close to 2%. The Governing Council has reduced the policy rate substantially since the month of June, and those cuts will be working their way through the economy. Going forward, we will be evaluating the need for further reductions in the policy rate, one decision at a time. In other words, with the policy rate now substantially lower, we anticipate a more gradual approach to monetary policy if the economy evolves broadly as expected. Our decisions will be guided by incoming information and by our assessment of the implications for the inflation outlook.
To summarize, inflation is back to the 2% target, and lower interest rates are beginning to pass through to stronger spending by households. But the economy remains in excess supply, and the growth outlook now appears softer than we projected in October. With inflation back to target, we've cut the policy rate by 50 basis points at each of the last two decisions because monetary policy no longer needs to be clearly in restrictive territory. We want to see growth pick up to absorb the unused capacity in the economy and keep inflation close to 2%. The Governing Council has reduced the policy rate substantially since June, and those cuts will be working their way through the economy. Going forward, we will be evaluating the need for further reductions in the policy rate, one decision at a time. In other words, with the policy rate now substantially lower, we anticipate a more gradual approach to monetary policy if the economy evolves broadly as expected. Our decisions will be guided by incoming information and our assessment of the implications for the inflation outlook. The bank is committed to maintaining price stability for Canadians and keeping inflation close to the 2% target. With that, the Senior Deputy Governor and I would be pleased to take your questions.
Okay, thank you, Governor. We will take questions first from the reporters who are here in Ottawa at the bank, and then we'll go to those who have joined us remotely. I'm going to ask everyone to please limit yourself to one question so we can get to every media outlet in the brief time we have together today. If I forget to do so, please state your name and affiliation. And I think we're all veterans here, but just in case, please remember to push the green button in front of you to activate your microphone, and then push it again to shut it off once you've done asking your question. Avant de poser une question, vous identifier si je...
Please identify yourselves before asking your question. And of course, you can ask your question in the official language of your choice.
And I'm going to go to Najoud Al-Malise from the Canadian Press, please.
Hi, Governor. It appears that, sorry. It appears the government is ditching at least one of its fiscal guardrails, and last fall you called those guardrails helpful. Do you find them leaving them? Do you find the government ditching them unhelpful?
Well, Jude, look, I am a fan of the fiscal guardrails, but we're all going to get the fiscal update next Monday, and we'll read it with interest. I expect you will too. And between Monday and our next projection, which comes out January 28th or 9th? 29th. We will, whatever measures are in there, we'll take those on board. We'll build those into the projection. So, like, I'm not really going to. Let's see the whole fiscal update in its totality, and we'll do the assessment. We'll discuss it in January.
Okay, next I'll go to Pramit Mukherjee from Thomson Reuters, please.
Thanks, Paul. Good morning, Governor. The economy is not really in a very bad shape. It's not teetering. And the GST rebate, it can actually boost consumption. Then the cash handout from the federal government or the Ontario government also can do that. And inflation also most likely will be up because of base effect. So in such a scenario, don't you think a 50 basis point cut gives a signal that the economy is almost at the edge of recession?
Look, if your question is, okay, 25, 50, why 50, why not 25? We discussed both options. And, as you indicated, the data since the last decision has been somewhat mixed. For every, there's negatives, there are also some positives. I mean, if you look at Q3 GDP, it came in at 1%, weaker than we were expecting, but consumption growth, housing picked up. You're starting to see lower interest rates pass through to household spending. The labor market continues to soften. The national accounts revisions, on the other hand, suggested GDP growth, or GDP level, has been stronger over the last 3 years. So, yes, there are some mixed signals in the data. And look, the Governing Council, we did chew through that. We did coalesce, though, around a 50 basis point cut, really for two reasons. First of all, the Council agreed we no longer need monetary policy that's clearly in restrictive territory. We did need restrictive monetary policy when we were getting inflation down. Inflation's been too high. We needed restrictive monetary policy to get inflation down. It's worked. Inflation's been around our 2% target since the summer. And against that background, the Governing Council agreed we no longer needed monetary policy that was clearly in restrictive territory. And then the second element is, when you look at all the data, it does tilt towards a softer economic outlook, a softer outlook for GDP growth than we published in October. As I said, Q3 growth has come out weaker than we expected. It looks like Q4 is going to be a bit weaker than we projected. Add in the fact that the government has lowered their immigration targets for next year. That's likely to pull GDP growth down next year, so we're not going to get it back. So you put that together, both of those factors really signaled that a 50 basis point cut made sense.
Next, we're going to go to Paul Vieira from the Wall Street Journal, please.
Good morning. How much of this half-point cut, or let me rephrase that, sorry. How much was the threat of President-elect Trump's 25% tariff? How big a role did that play in making a half-point cut, and perhaps the Bank of Canada wanted to take out some insurance in the event this happened before the January 29th decision?
You saw in the press release, we did underline that the threat of new tariffs on Canadian exports, particularly at the level that's been suggested, that is a major new source of uncertainty. But the reality is, we don't know if those tariffs are going to be implemented. We don't know if exemptions are going to be agreed on some parts. We don't know what level of tariffs. We don't know if Canada will take retaliatory measures. All those things, if you want to work through the economic consequences, all those things are very important for determining what this means for the Canadian economy. We can't run policy on something that might happen. We have highlighted that it is a major uncertainty, and certainly if you're a business considering making an investment decision, even that the fact that things are uncertain, that will probably hold back your decisions until there's some more clarity. So it is probably already having some effect on the data, but really the decision we took today reflects what we see in the data, and if there is a big change, we're going to have to take that on board. Look, there's no question that if these tariffs were to move forward at the level suggested, it would be highly disruptive to the Canadian economy. It would also be very disruptive for the U.S. economy. Hopefully that doesn't happen, but we did highlight it as a risk.
Okay, next I'm going to call on Jordan Gowling from the Financial Post, please.
Morning.
morning. Former Bank of Canada Governor Stephen Poloz made some comments last week. He said that population growth has masked underlying weakness in the economy and that we're in a recession. What's your response to the comments made by your predecessor?
What's my response? Well, let me say, how do we see it? I mean, I'll let people decide what adjective they want to put on it, but I mean, the traditional definition of a recession is, at least two negative quarters of growth in a row. The Canadian economy is growing. Third quarter growth was 1%. It's not growing very quickly, but it is growing. Yes, as Stephen Poloz pointed out, if you look at things on a per capita basis, we have seen a number of negative quarters. And that really reflects the fact, yes, I mean, we are in excess supply. The economy has been soft. I think when you look at over the last couple of years, I mean, we've lowered inflation from 8.1% to 2%. And if you just look at the labor market, yes, the unemployment rate has gone up, but we have not seen widespread layoffs. We have not seen, people, widespread job losses as you would typically see in a recession. So, look, we needed to slow the economy. We needed weak growth to take the steam out of inflation. That has worked, but we haven't created widespread job losses as you would typically see in a recession.
Okay, I'm going to go to the other side of the room now to Randy Thantong-Knight from Bloomberg, please.
Hi, Governor. How much do you worry about Canadian dollar weakness leading to a surge in inflation down the line, or do you welcome a weaker loonie as a counterbalance to the potential U.S. tariffs and any retaliation from Canada?
Well, I need to just begin by reminding everybody that we actually don't forecast the Canadian dollar. When we run our forecast, we take whatever the current level is, and we don't target the exchange rate. We target inflation, and in fact, the flexible exchange rate is a key part of the framework. It's what allows us to run monetary policy geared to the needs of the Canadian economy. So if you go back to the last monetary policy report in October, the Canadian dollar was sitting around 73 cents. This morning it's a little over, it's between 70.5 and 71 this morning. So yes, it is weaker, a little more than 2 cents weaker. And so what is driving that depreciation? Well, I think most of that depreciation in the Canadian dollar is really an appreciation in the U.S. dollar. The U.S. dollar has been strong against pretty much every other currency. If you look at the Canadian dollar against other crosses relative to major currencies other than the U.S. dollar, it's actually very little changed. The fact that the Canadian dollar is weaker, as you said, that is actually one of the channels through which monetary policy works. A lower Canadian dollar makes Canadian exports more competitive in the U.S., and so that will add demand to the Canadian economy. It also makes imported goods more expensive, so that can also have some impact on inflation. So those are both things that we'll need to take into account in the conduct of monetary policy. Until recently, the Canadian dollar has actually been remarkably stable. We have seen some depreciation. That is something we'll have to factor in.
All right, let's go to Mackenzie Gray from Global, please.
Hi there. I guess this is for the Deputy Governor, but Governor, chime in if you'd like. There's been a lot of talk about housing from both of you guys and the impact of immigration on that. I know you'd say a little bit more about immigration later, but just broadly, what is the bank's view on how the immigration reduction targets will impact housing going forward?
By now I answered the housing questions.
Well, I figured that out a few times now, but...
Yeah, so, I mean, what we've seen in housing recently is a pretty big uptick in activity, and it's come without a commensurate uptick in prices, so that's actually been quite good news. There's some mortgage rule changes to come another 50 basis point cut. And we know housing is very sensitive to interest rates. So we do expect some more pickup. Whether the immigration, reduction in immigration will sort of act as a counterbalance to that, that's very possible. We'll have to keep an eye on it. But so far, an increase in activity without an increase in price is a good thing for the Canadian economy right now.
Okay, I'll go to Greg Quinn from Market News, please.
Hello, happy holidays. Returning to the R word here, you lay out the risks of growth has lagged your forecasts. It's going to be slower because of the restrictions in immigration and the wild card of tariffs. In terms of what might happen next year, doesn't this return us to a potential scenario of a hard landing or a recession in Canada?
Well, we don't have a full forecast for you. We will have an full updated forecast in January. But and look, as I said in the opening statement, I expect the GDP forecast in October, GDP growth will be lower than what we forecast in October. Having said that, you can see in the Q3 data and in more recent indicators, consumer spending is picking up. Consumer spending was, grew 3.5% in the third quarter. Since then, we've reduced interest rates a further 100 basis points at the last two meetings. So, yes, we do think population growth is going to be coming down considerably next year. That will pull GDP growth down because there's going to be less new consumers, less new workers in the economy. At the same time, we are expecting per capita spending or per capita GDP growth to be recovering. So we're not expecting a recession. It does, with those two things going in opposite directions, you're not going to see growth really accelerating because population growth is going to be pulling it down. More per capita growth is going to be pulling it up. We'll see exactly, what the dynamics are, but we will continue, our baseline will continue to be the economy's growing.
Okay, next we'll go to Mike Lukacher from CTV, please.
There we go. Hi, thanks for taking our questions. I want to go back to the tariff question. I know you had said earlier you can't run policy on something that might happen, but how differently and how drastically does that affect your forecast going forward with that hanging over you? Because that is certainly a factor that I think a lot of people are thinking about.
Look, as I said before, if tariffs were imposed at the levels that have been suggested, it would be very disruptive to the Canadian economy. Working through the effects is going to depend a lot on exactly what the tariffs are on, whether there are exemptions, whether there's retaliation. We are, of course, doing some analysis to see what those effects could look like. And in fact, if you want a reference point, if you go back to, I think it's the July 2019 Monetary Policy Report, we actually have an extended appendix where we looked at, actually, interestingly, a 25% increase in tariffs. It wasn't exactly what's been proposed because it was across everybody, not just Canada. And what you see there is, yes, it has a major impact on GDP growth in Canada. So yes, we are dusting that off. We are looking at different scenarios. And, if those things happen, certainly they will have a big impact on the Canadian economy, and we'll have to, it will have a dramatic effect on our forecast, and we'll have to, as a governing council, consider what that means for monetary policy. As I said, let's hope that does not happen. But what we're doing is we're doing some analysis to get prepared for that possibility. I think that's all we can do. Unfortunately, monetary policy can't eliminate that uncertainty. We can hopefully be with inflation back to 2%, with interest rates now substantially lower, hopefully we can play a role of providing some stability, but we can't eliminate that.
Okay, we'll go to Kevin Carmichael from The Logic, please.
A question about business investment. You noted that consumption seems to be finding new life, but business investment still seems dead. Do you think you've lowered the cost of capital enough to encourage some investment, or do you anticipate that that stall to continue?
Look, Kevin, as I said, we don't have a revised forecast. If you go back to the forecast we had in October, the typical sequencing is household spending picks up first. The combination of stronger demand and lower interest rates starts to, next you start to see investment pick up. The fact that right now we're starting to see some pickup in consumption, you would expect to see a lag to investment. As I highlighted earlier, the uncertainty resulting from the threat of new U.S. tariffs is probably going to weigh on, it's going to be difficult for businesses to take decisions against that background. So, we'll have to look at what we'll be doing surveys. We will be able to get hopefully a better fix by the time we get to January. But yes, I think there is a risk that investment is weaker.
Okay, we got one more question here in the room, and it is from Mark Rendell of the Globe and Mail.
Thank you for taking the question. So in the October statement, you said we expect to reduce the policy rate further if everything comes in line. You've changed that. You've removed the statement saying we expect further cuts. You're also now talking about moving to a more gradual approach to monetary policy. Are you expecting to cut rates further? And how should we be thinking about this shift in language to discuss a more gradual approach to monetary policy?
So what's next? Well, let's just start with the present for a minute. The last two decisions we've cut by 50 basis points. And as I highlighted earlier, really what, central to that was inflation. With inflation now back to 2%, the Governing Council agreed that monetary policy no longer needed to be clearly restrictive. So if you go back to June, we have now cut our policy rate by a total of 175 basis points, bringing it from 5% down to 3.25%. That's a lot. That's substantial. And those cuts will be working their way through the economy. So going forward, what do I expect? Going forward, I expect the Governing Council will be considering further reductions in the policy rate. But as I've said, with the policy rate now a lot lower, if the economy evolves broadly as we're expecting, I anticipate we'll be taking a more gradual approach. So what does a more gradual approach mean? Well, we've just cut by 50 basis points at the last two meetings. So more gradual is more gradual than that. That is obviously a pretty wide zone. That's deliberate. We're going to take our decisions one meeting at a time based on the best available information and our assessment of its implications for monetary policy.
Okay, that is it for In the Room. We're going to go to those reporters who have joined us online. I'll just remind you folks, please, to come off mute only to ask your question, then go back on mute as soon as you've finished. That way everyone will be able to hear the response. And I'm going to call first on Alicia Sikierska from Yahoo Finance.
Thank you for taking our questions. I just wanted to follow up on Mark's question. Given Canadians should expect a more gradual approach to policy easing, should they be prepared for a pause? I mean, what's your message to them going forward as they plan their lives, continue to renew mortgages, et cetera?
I don't really have much more to add on the previous answer. We've lowered interest rates substantially. And at the last two meetings, we took two bigger than normal steps. What we're signaling is, yes, we expect we will be considering further reductions, but when we look at things now, our thinking is we'll be taking a more gradual approach. And look, the reality is we're going to take those decisions one meeting at a time. We'll look at the information we have in January. We'll do the assessment. We'll take a decision. But the idea here is we're trying to share how we see things, what our thinking is, what is our mindset going forward. And these, we want to be as clear as we can with Canadians, but we have to, you got to remind people that, yeah, these are conditional statements. We're going to take our decisions one meeting at a time at the end of the day.
Okay, next we'll go to Max Sato from Mace News. Go ahead, please, Max.
Thank you, Paul. Good morning, Governor, Senior Deputy Governor. My question is about the appropriate inflation target is for both of you. First, Senior Deputy Governor Rogers, during your fireside chat in Toronto, you mentioned that it's a good time to review the target, and you mentioned other things like outreach and internal research. So what are the Canadians telling you about how they feel about the target, and how is your internal research going? And for Governor Macklem, you often asked whether the bank should adopt a higher inflation target. And in one of your comments in Parliament a few months ago, you made a point saying, what's the point of having a target if you can't keep it? Could you expand on that issue from the viewpoint of whether there's anything we could learn from other central banks' target ranges, such as Australia's 2 to 3% and India's 2 to 6? Thank you very much.
You want me to go first? All right, Tony, that's a wide-ranging question. So I think what I was referring to in the fireside chat is the bank regularly, every 5 years, reviews our inflation targeting framework, and that's coming up. And as part of that review, we always undertake a broad outreach to Canadians. We talk to academics, we talk to economists. That process is just getting going, so I can't give you a lot of feedback right now about what we're hearing from Canadians, but I can tell you that we will make sure that we give Canadians a chance to feed into that discussion. It's good timing in the sense that we're coming out of a period where we were all reminded how difficult inflation is for Canadians, and so I expect, perhaps unlike previous reviews we've done in past years, there would be more Canadians who want to participate and give their views this time around.
Yes, you're right. I did say that, if you change your target just because it's tough to get back to your target, well, you don't really have a target. And I am a big believer that the target does provide an important anchor to the whole system. As a senior deputy governor just highlighted, we do periodically, every 5 years, review our inflation targeting framework, our monetary policy framework. And that is the appropriate time to ask yourselves the questions, is the framework that we have today the best available framework for the future? And so, yes, we will be, we are starting to talk to Canadians, talk to business, talk to experts. Right now it's been, a lot of it has been more about, well, what should the questions be? And I will have a little bit more to say about this actually next Monday in my year-end speech in Vancouver, because certainly as we look to next year, that is going to be an important, we will need to launch the review next year to be ready for 2026.
Okay, we'll go now to Rob McClister from Mortgage Logic News, please.
Good morning. Thanks partly to immigration, Canada is seeing a rising unemployment rate, but we're also seeing rising employment in general. So from the standpoint of driving inflation, does the persistent climb in absolute employment levels matter maybe a little bit more than the unemployment rate, if it means more people are working, creating more aggregate demand?
I guess the way I would respond is, you're right that you can't summarize the health of the labor market with one number. So you can't just look at the unemployment rate. You can't just look at the employment rate. You need to look at a range, the full range of indicators. And then, what are we seeing? Well, what we're seeing is that, businesses are still hiring. Their hiring is not very strong. And importantly, it's not keeping up with the number of people that are entering the labor force. So you're seeing the unemployment rate go up. And if you look at the composition of who's unemployed, it is particularly concentrated in young people who are entering the labor force and newcomers to Canada that are entering the labor force. And what they're finding is it's taking a long time to find a job. And that is pushing up the overall unemployment rate. We haven't seen widespread layoffs. We haven't seen widespread job losses. But, when you look at the labor market overall, at an unemployment rate of 6.8%, and with youth unemployment having risen quite a bit, there is clearly some slack in the labor market. And going forward, we want to see growth pick up. We want to see hiring pick up, and that the fact that we have lowered our policy rates substantially should start to boost growth further. We are starting to see already the pass-through to stronger household spending, and we expect to see household spending on a per capita basis as well as an absolute basis pick up further.
Et pour terminer, nous avons Gérard.
And to conclude, Gérard Filion. Mr. Filion. Yes, hello. A few times in English, you referred to this, so could you give us your explanation in French with respect to the 25% tariff threat? You're saying there will be more analysis provided in 2025, but given the concerns related to the possibility of these tariffs being imposed, perhaps you could give us a bit more of your thinking on this. Certainly, if these tariffs are imposed, and it is a major threat, it will have an important effect on the Canadian economy. As I mentioned earlier, in terms of monetary policy right now, we cannot design our monetary policy or adjust our monetary policy based on something that might happen. But if it does happen, yes, we anticipate that there will be major implications for the Canadian economy, and this is something we will have to look at with respect to our policy. Now, the impact on the Canadian economy will be affected by a number of different dimensions. What kind of tariffs are we talking about? How high will they be? Will there be exceptions? Will Canada impose tariffs on U.S. products? So there are all kinds of questions that surround this issue, and the effects will depend on exactly what happens. So right now we are preparing, we are conducting analysis, and as I said, there was some analysis provided in our monetary policy report in July 2019, where we looked at various scenarios, and we are currently looking at these scenarios again. And if there are concrete steps taken along those lines, we will have to look at what the potential effects could be. But right now, there is a great deal of uncertainty surrounding that.
Conclude today's press conference. Thank you, Governor, Senior Deputy Governor. Thank you all for joining us today.
Thanks very much.
Happy holidays.
Yeah.
Thanks for your work.
Go Seahawks.
Go Hawks.